Hey guys, I'm Danny. This is Capital Cosm, but this is not financial advice. I am not a financial advisor. Please do your own due diligence. Everything on this channel is for educational purposes only. All right, let's get started. So, today we had the drop of the CPI up 7.1% year over year. Now, 7.1% may have been a big deal in 2021, but sentiment around Twitter, the sentiment around the market is awfully positive due to the fact that despite the fact that we are increasing at a decreasing rate. So instead of going up by 9% year over year, we're only up by 7.1%. So that's kind of the way the markets work. Early this morning, we saw a pretty big rally in the futures market across the Dow, the S&P, the NASDAQ, as well as oil. You can see here, NASDAQ was up 3%. Over 3%. The S&P futures were up 2.24%. The Dow futures were up nearly 2%. JP Morgan had forecasted a 4 to 5% rally in the markets in the S&P if the headline CPI was in the range of 7 to 7.2%, which is the range that we hit. So we were up to a pretty strong start this morning. So what happened? Let's take a look. Let's take a look at some of the closing numbers. We started off strong, but the sugar rush quickly faded away. Dow Jones finished up 0.3%. The S&P 500 finished 0.73%. And the NASDAQ finished at 1.01%. All well below their futures high to kick things off this morning. So what happened? The CPI... Again, despite the fact that we saw a lower than expected CPI, the CPI was expected to come around at 7.3%. So we did better by about 0.2 percentage points. So Zero Hedge here has a pretty interesting chart that we can look at. It's the biggest drop in headline year over year CPI since the COVID crash. This is where we are as of today, as of this month. We saw a bigger decline month over month in our headline CPI number than we've seen since, well, the beginning of the pandemic, back in, April of 2020. So this is something that's unprecedented. And the reason why I speculate, and the market responded to a higher rally, well, let's think this through. What happens when we have lower than expected CPI? What does that actually imply? Number one, it implies that the Fed is going to loosen up on rate hikes. After we lower rate hikes, what does that imply? That implies a weaker dollar. And what does a weaker dollar imply? That implies a tailwind to our energy and commodity stocks, as well as stocks in general. So the market is always forward looking. It's the same reason that we see precious metals like gold, which is supposed to be a monetary metal, go down in the event of higher CPI prints. You would think that a higher CPI print would yield higher prices in gold. But no, because the market is forward looking, the market is always going to price in gold into the future. So because the CPI print comes out high, the market anticipates rate hikes, which are headwinds to gold. It's the same story here. Just play it out in reverse. A lower than expected CPI implies lower rate hikes, which implies a tailwind to a weaker dollar, which is a tailwind to stocks and assets in general. So that's what was going on this morning. Let's go up and take a look at some of the high-performing assets of the day. So early this morning, we had all the commodities. All the popular ones: gold, silver, copper, platinum, palladium, crude oil, WTI, Brent oil, all in the green, well into the green. If we look here, let's check out where we're currently standing now. Oil's currently at $75. WTI oil is at $75. Brent crude is at $80.22. And nat gas is at $6.85. So we have seen a bit of a correction since the early mornings of this market, but nonetheless, we're still seeing the likes of gold in the 1800 range. we're still seeing silver just knocking on $24, which it did break today. Copper sitting at $3.85, still up as of this recording. So the lower than expected CPI print has investors happy and on a sugar rush, anticipating a potential rate hike or more of a dovish signal tomorrow when the Federal Reserve is supposed to announce their next rate hike. Is it going to be 75 basis points or is it going to be 50 basis points, which is consistent with the signals that they've been sending to the market over the last month or so? All right. Peter Schiff here says, if 1 month of a lower than expected CPI is good news, why is the dollar tanking and gold up $30? The reason is that a lower CPI gives the Fed an excuse to ease up on the inflation fight. Exactly. That means even higher future inflation, which is bad for the dollar and good for gold. You see how forward-looking the market is. The market is always looking ahead. This is another interesting chart. A false breakout. What do you think? Danielle DiMartino Booth, she writes, we still think the Fed will signal that it will maintain rates near the peak for longer than market is pricing, which means front end knee-jerk rally, that's the rally that we saw today, may not have legs, while long end may retest recent yield lows, flattening curve a bit further. So what does this mean? Let me spell it out for you. Because we saw the rally in stocks today, because we saw such a positive response to a lower than expected CPI, because the CPI was lower than expected to begin with, this will embolden the Fed to actually keep raising rates, because now there's no longer an incentive to lower rates. If everything was collapsing, that would be your incentive to lower rates. But if everyone is still fat and happy, then why should the Fed take their foot off the gas pedal? That's what everyone else is missing, and that's what Danielle DiMartino Booth is saying here. Fabi. So Fabi is one of the bigger names in the uranium investing space. He says, the easiest gimmies in investing are when it's boring. Today, it's boring. Let's take a look at URNM. How did URNM do today? Despite the green across the various commodities, despite the green across the various stock indices, URNM, the uranium miners ETF, actually finished in the red, down 0.64%, pretty much flat. But the point being is that you never want to invest in excitement. When you invest in excitement, you're dealing with the fact that you've got all of the retail investors piling on. You want more potential buyers on the other side that could potentially come into your trade and increase the market cap of your asset versus everyone already being in it to begin with. So that's the gist of what Fabi here is trying to say. This is a funny one from Rudy Havenstein. He says, this is a little skit he made up. So Fintwit goes to the supermarket. Fintwit, hi, what a cute baby. Can I ask you a few questions? Mom says, okay, real quick. Are you excited about the disinflation? The mom says, what? The disinflation. The inflation was 9%. Now it's only 7%. Are you out of your effing mind? The mom says. Well, of course, we can sit here and we can postulate about the ramifications of going from 9 to 7%. But at the end of the day, normal everyday people don't care about deceleration. They want to see prices come down, not go up at a slower pace. I just thought that was a funny little skit that Rudy Havenstein put together. This is a cool quote from Warren Buffett. He says, the most important quality for an investor is temperament, not intellect. Again, it's easy to fall into FOMO. It's easy to fall into FUD. The fear of missing out is FOMO. FUD is fear, uncertainty, and doubt. The reason why that is because we as human beings, we have a lag between our logic and our emotions. Our emotions always come before our logic. Emotions are always upstream of logic. And that's why it's always harder to control your temperament. It doesn't matter how smart you are, because at the end of the day, we're all creatures of our emotions. Just thought that was that's a very interesting piece of wisdom. It's a very interesting pearl of wisdom from the great Warren Buffett. Okay, so so stocks did come down from their sugar high, as we saw earlier in the video. Here I say the reason why uranium has been chopping down and sideways for so long are narrative related. So for all the you uranium investors out there, that you may be wondering why have we seen a trend down or a chopping sideways of uranium? Well, let's take a look. Uranium has been pretty uninteresting, as Fabi alluded to. Let's pull uranium up. Let's look at the URNM, the uranium miners ETF. So uranium has been kind of consolidating for the better part of a year now. You can see that we've been moving in this ascending support line since 2020. Again, the strength of a support line is a factor of how long the support line is, the time duration of the support line, as well as the number of times that we actually touch that support line. So this is a pretty strong support line, and we have a descending resistance line as well. So we're kind of building up into this channel here, into this crescendo around June of 2023. But uranium has been pretty boring. And the reason why the reason why I see this being the case is due to the shelling of the Zaporizhzhia power plant in Ukraine. One of the biggest fears in the hearts of many uranium investors is a nuclear incident, in the same vein as Fukushima. Fukushima destroyed the uranium market for a decade. We were riding high in 2011 up until Fukushima. And another reason, I believe, is nuclear fusion breakthroughs. You may have heard of the breakthroughs in nuclear fusion. Now, this kind of stuff, especially with nuclear fusion, this is decades away from implementation. But the market is always the market is always receptive and reactive to narrative. Narrative drives prices in the short term, but prices will eventually react to what's real and what's not. Eventually, there won't be any shelling around Zaporizhzhia. Eventually, people and investors will come to realize that nuclear fusion is decades away from implementation, and our current uranium market isn't in any danger of seeing a massive correction a la 2011. Hopefully not, at least. I mean, that's what I think. I could be wrong. What do you think? Let me know in the comment section below. So, this is a cool tweet from Josh Young. He says, from Bloomberg, oil giants are poised to have their international spending growth next year in response to lower crude prices, dealing another blow to global market already facing a drawdown in production, U.S. shale fields. Okay, so what do we have here? The fact that oil has been pushed so low in its price has de-incentivized oil producers from producing oil. It's the law of unintended consequences. So the fact that we want short-term pleasure with lower oil prices, so we flood the market with SPR releases, strategic petroleum reserve releases, do all sorts of chicanery in the paper market to bring the price of oil down. Well, what's an unintended consequence of that action? It's the fact that oil producers aren't incentivized to produce oil at these low prices. So you're going to see more supply deficits into the future, not more supply, while retaining demand, especially with the rumors of China coming on. So the right hand doesn't always know what the left hand is doing. And then finally, Zero Hedge here shows a pretty cool chart on M2 versus CPI. So let's take a look at this. So this is a year over year for both M2 and CPI. M2 is your broad money supply growth. You could think of it as the aggregate money supply in the economy that's sloshing around. The more money that's in the economy, Milton Friedman said, the greater the consequences of inflation. Makes sense, right? So here we have M2 and CPI charted out since 2011. M2 is in red, while CPI is in blue. And you can clearly see a correlation. The CPI and the M2 money supply seem to track one another fairly closely. We peaked here in CPI, somewhere around 9%. We peaked here in M2, somewhere around, I don't know, what is that, 27% year over year? And now M2 has gotten ahead of CPI. We haven't seen much M2 growth in the last, year now. It looks like the CPI is tracking M2 all the way down here. So what do you think? Do you think we are going to track the CPI back down to, near zero numbers? Are we going back down to, are we done with inflation? Or is this simply the first peak of inflation? This is another thing to consider. Here we have, again, the exact same chart, M2 money supply growth versus inflation growth. And we have inflation in red, we have the M2 money supply growth in black. And again, we see the same correlation between the two measures. And if you look closely here, in the 1970s, we had multiple waves of inflation. We had one here and we had one here. So are we going to see the same thing today in current modern times? Are we just at the very beginning of the decline of the first wave? Is there a subsequent wave ahead of us? Is there more than one subsequent wave ahead of us? I don't know. What do you guys think? Do you think this is the end of the line for inflation, in that we will pretty much stamp out this high inflation environment by next year? So this chart is really nice. We can also go all the way back to like the 1800s, and this is a very strong correlation we've got. So yeah, we see that same decline in M2 growth, down to 1.28%. Are we going to get down to that level? Let me know. All right, guys. Well, that's what I got today. Go ahead and give me a like if you like this content. Give me a dislike if there's something that you want me to change and you didn't like this content. Please subscribe to the channel down below. And if you have Twitter, please go ahead and follow me on there. My handle is @CapitalCosm. So let me know what you think, and I'll see you next time. Bye.